Hello traders, in this video we're going to cover a breakout trading method that revolves around the inside bar candlestick setup. So what exactly is an inside bar pattern? The inside bar is made up of two candles where the second candle's full range stays completely within the high and low of the candle that comes before it. If you look at this chart example, you'll notice the high and low of the second candle fall entirely inside the range of the previous candle. This is what qualifies it as a valid inside bar. However, many traders often get it wrong and mistake an invalid inside bar for a valid one, which can lead to poor trade decisions and losses. Take a look at this chart here. Although the body of the second candle lies within the previous candle's range, the wicks go beyond the high and low, making it an invalid inside bar. Now let me ask you a question. Why do we see an inside candle forming? The inside bar pattern isn't actually a direct indication to buy or sell, it's more like a consolidation signal. This is because throughout the time the candle was active, the market didn't make significant progress, it simply hovered within the range of the prior candle. Now let's get into the details, but before we continue, if you're finding this useful, go ahead and click the like button to show your support, and if you're new to the channel, don't forget to hit subscribe. We'll get started right after the intro and disclaimer. Welcome back traders. So when you see an inside bar form, it signals a pause or a brief consolidation phase in the market, and consolidation suggests that buying and selling pressure are balanced. So a breakout from the inside bar implies that price is leaving that balanced zone and is ready to move in a specific direction. As a price action trader, when you notice an inside bar on your chart, you should view it as a potential setup to enter a trade. Now the main question is, how do you approach trading the inside bar? Once you open your chart, the first thing you need to do is perform a market structure assessment to help you answer four key questions. Is the market currently in an uptrend? Is the market moving in a downtrend? Is the market in a sideways range? Or is the price action too messy to interpret? Let me walk you through an example. As you can see, in this case the market is clearly trending upward. Based on the market structure analysis, we can identify a series of higher highs and higher lows. This is a key observation because it confirms that the buyers are currently dominating the market, and the smartest approach is to look for buying opportunities whenever they arise. So in this upward trending scenario, we notice a clean inside bar setup, and as we discussed earlier, an inside bar signals a moment of pause or consolidation in price movements. So once we identify this candlestick pattern, our plan is to wait for the breakout of the inside bar and use that as a trigger to enter a long position. What we're essentially trying to do is catch breakouts that align with the prevailing trend momentum so we can enter the broader trend with a favorable price point. Here's a pro tip: traders will come across plenty of inside bar patterns on their charts, but it's important to recognize that aiming to trade every single one isn't smart. Low volatility phases and deep consolidations create weak trading environments, and any inside bars that form in those conditions should be viewed with caution. Let me give you an example. As shown here, the market is in an uptrend, but in this area price action is slow and lacks momentum, so taking this inside bar candlestick setup would be risky. What we really need is a trending market where the price movement shows some strength. This increases our chances of successfully joining the trend at the point where the inside bar breaks out. As you can see in this example, the trend is clearly moving upward and the momentum is strong, so the appearance of this inside bar signals a temporary pause, and its breakout presents an excellent chance to enter the ongoing uptrend. So now you understand that in a rising market we look for inside bar setups that align with the upward direction. But what if the market is trending downward? Let me show you another example. As you can see here, through our market structure analysis, we observe that the market is forming lower highs and lower lows, which clearly signals a downtrend. This insight is important because it tells us that sellers are in control and we need to look for a way to align with the downward movement. The inside bar pattern gives us an excellent setup to do just that. We simply wait for the breakout of the inside bar and then execute a sell entry. So now you've learned how to recognize a trend and how to position your entry to follow the trend using the inside bar candlestick pattern. But what happens when the market isn't trending? Let me give you another example. As shown here, by examining the market structure, we can see that price is moving between horizontal support and resistance levels, which means the market is in a range. In this scenario, buyers and sellers are evenly matched, and the smartest trading choices come from entries made near either support or resistance. In this case, we spot a clear inside bar forming at the resistance area. We'll wait for the breakout to enter the trade, place a stop loss just below the candle, and aim for the next support level as our target. Take a look at another example here. The market is moving between horizontal support and resistance levels, so we'll wait for an inside bar to form at either the support or resistance zone. In this situation you can see a strong inside bar setup forming at the support level. All you need to do is wait for the breakout of the inside bar, set your stop loss just below it and aim for the next resistance level as your target. Here's a pro tip: during range-bound market conditions, the most reliable trade opportunities are always found near support or resistance. We should avoid taking trades that develop within the middle of the range. Now look at this example. This market is unclear and difficult to read. The price action has no direction, so we can't base any trade decision on it. If an inside bar candlestick forms in such uncertain conditions, it's better to skip it because there's no reliable indication of where price might go. Alright, so now you've learned how to use inside bars to trade uptrends, downtrends and sideways markets, but how can you tell which inside bar setups are worth taking? Since these patterns show up frequently on the charts, we need a few simple filters to avoid high-risk trades and focus on strong breakout opportunities. When using the inside bar candlestick strategy, the time frame you choose is crucial. It's best to trade on the daily time frame or the 4-hour chart. You can also use the 1-hour chart, but anything below that is not advised. If you try to trade inside bars on a 5-minute chart, chances are you'll end up losing your capital and your sanity along with it. Take a look at this chart example as shown here. This is a 5-minute time frame and you can see multiple inside bars that didn't work out, and that's completely normal because candlestick pattern signals are generally unreliable on lower time frames. You can still trade short time frames if you're applying scalping strategies, but if your approach relies on price action and candlestick patterns as trade signals, then it's essential to focus on higher time frames. Now take a look at the daily time frame to see the contrast. As you can see here, the market structure is much clearer and most price action signals tend to perform better. This is a strong inside bar setup that played out well. Inside day breakouts on the daily chart often result in low risk, high reward breakout opportunities. So to summarize, let me walk you through the steps you need to follow when trading the inside bar candlestick setup. Focus on higher time frames like the 1-hour, 4-hour or daily chart. Begin with a market structure analysis to determine whether the market is trending up, trending down or moving sideways. Then use the breakout of the inside bar as your trade entry signal. That's all for now, traders. Thanks for tuning in. I hope you found this video useful and informative. If you did, don't forget to hit the like button, subscribe to the channel, and turn on the notification bell so you stay updated with all our latest content. We really appreciate your feedback, so feel free to leave a comment below and share what topics you'd like us to cover in upcoming videos. Thanks once again for your support. We'll catch you in the next episode.